Hey, everybody. As we close out 2024 and start putting our mind on 2025, I want to share with you the three strategies, option selling strategies, that are the best strategies for 2025. The first one I want to share with you is Cashsecure puts. And why is this one great? Well, it's a really good strategy because it's going to give you the opportunity to buy stocks at a discount. You can earn a premium or earn, some money while you're waiting for the price to come down to the strike price or to the price that you want to pay for the stock. So, for example, you're selling puts on. I'm just gonna pick Apple because that's a common stock. You're selling puts on Apple, and you're going to sell them for, let's say, $150. You're gonna basically receive a premium while you're waiting for the price to come down to $150. Will it ever come to $150? Maybe, maybe not. Don't know. But you pick a strike price that is really in the range, and at a price that you're willing to pay for the stocks. The way it works is basically you sell a put on a stock that you want to own, right? You should do it on something that you actually want to acquire. And you want to make sure that you have enough cash in your account to be able to purchase 100 shares of the stocks for each of the contracts that you want to sell puts against. All right. The best practice is basically you want to choose high quality, strong stocks. Sometimes people do this strategy and they only want to do it for the premiums and the income, and that is fine. Just know that if you end up acquiring the 100 shares or so of the stock, then you want to have an asset that is going to be useful for you. You can target about 30 to 45 days out. Use a delta of maybe 30 or 40 to give you a good balance between premiums and the probability of you getting the shares and the probability of you being successful. Some people do this strategy just for money. Others do it to acquire the stock, right? If you're interested in something, a little bit more information on that, I do have a little bit of a training inside of my Educator to Trader website that will talk about how do we sell Cashsecure puts. The second strategy that I think is one of the three best for 2025 is covered calls. Why are covered calls great? It is because you're going to generate income from your shares that you already own. The only way you can sell covered calls is if you already own at least 100 shares of the stock, or you have a long call that you're trading against. It's basic. You need something to cover your sold call. Basically, you sell a call option on a stock that you own or a long call that's called the poor man's covered call, and you set a strike price above the current market price. So if the price of whatever is $200 and you've got shares, you might sell your covered call at 201, 202, 205, 210, just something above the current price. And you do want to sell it. You want to sell your call at a strike price that you don't think the price will come to between the time that you enter the trade and the expiration that you select. All right. Unless you want to release the shares. And if you're okay with releasing the shares, then you can get a little closer. But just know if you're selling covered calls against 100 shares and the price does go up above that strike price and it is there at expiration, your shares will be called away. So if you really want to keep them, you want to pick a strike price that you don't think it's going to go to, or you want to buy to cover, or if you're selling them and you're okay with letting them go, then you just leave it till expiration, leave your covered call trade till expiration and let it expire. The best practices here, you want to use these on stocks that are steady or mildly bullish. You want something that is like holding steady, or it is going up a bit. And maybe not anything that's like got a big pop that's coming, maybe not during your earnings season. I mean, you want to be wise with the time and with the strikes that you pick. If the stock price gets too close to where your call strike is, and you don't want to release your shares, you can always roll it to a different strike price, or you can buy to close. You can basically buy that option and close it back, right? Maybe you want to target options with weekly or monthly expirations. That way you can have some flexibility. I personally am a fan of weekly expirations because I can choose 1 week, 2 week, 3 weeks. If you only pick monthly, then you can only pick once a month. I like having more options than that. All right. And if covered calls is something that interests you, there is a training inside of my website that is about covered calls. Now, the two together, covered calls and cash secure puts, do work together for a strategy that's called the wheel. Right? You run the wheel. The wheel strategy is that you sell cash secure puts, and if in the event you are gifted the shares or you are given the shares at the strike price that you choose, then you sell covered calls against those same shares until they're called away, or until time passes and you decide you don't want to sell covered calls against them any longer. But the strategy in my training, the covered calls and the cash secure puts, is the wheel strategy. I show you how to do it with shares and or how to do it with long calls. You can check it out, educatortotrader.com. Alrighty, the third way. Before I get there, I want to tell you, go ahead and like and subscribe. Please hit the notification bell, put the thumb up, all the good things. Let the people know that you like what we do over here in the option selling space, in the seller zone. You like it over here, and that let YouTube know that you want to send other people. All right, back to the show. So the third way, the third best strategy, I believe, for 2025 as an option seller is iron condors. Iron condors are a combination of put credit spreads and call credit spreads, right? So if you know anything about credit spreads, these two together at the same time are called an iron condor. And they're good because they work really good for stocks in the markets where the price is kind of within a window or consolidation area where the market is not very volatile going high or low, but kind of a low volatility market or a low volatility stock, right? This may be great on stocks that are like dividend stocks that don't really run too hard and fast. Some of the ETFs, some of the ones that aren't one directional, right? No hard and strong volatility in one direction. I already told you, you basically sell a call credit spread, you sell a put credit spread together, that becomes an iron condor. The best way to do the iron condor strategy is to focus on some indices like the SPY and triple Q IWM, and you want to maybe do those because they have higher liquidity. So you want to pick stocks that have good liquidity. But this is the little caveat here. You may want to go out 30 days or 45 days aiming for a 1-to-1 risk to reward ratio, because you want to basically see, I want to put up my collateral and I want to receive the same amount of premiums in return. So if you had a one spread, for example, on your put credit spread and your call credit spread, you want to receive $50 and you put up $50 of collateral. That's how that goes. And again, this is kind of a little more involved. I got training. I got a master class on credit spreads in my website, okay, educatortotrader.com. This is what we do. We trade credit spreads all the time. All right, so you're picking 30 to 45 days of expiration, and you're going to close the positions about the 50 or 60% profit mark. That way you can reduce your risk, all right? So now I've shared with you the 3 strategies that I think are best for option sellers for 2025. The first one, selling cash secure puts. The second one, selling covered calls, which goes right together with cash secure puts, and that is called the wheel strategy, WHEEL, the wheel strategy. And the third way I sold you was iron condors. Doing iron condors maybe at a 30 to 45 day window, 1-to-1 risk to reward, and pull in good premiums, close them about 50 or 60% in profit to reduce your risk. All right. Thanks for listening.